Hi all, in this educational video from TCM, we want to discuss a super important topic for day traders, and this is risk management. I'm not talking in this video about risk reward management, just about the risk part of the management. And of course, that's not a full analysis of a trade, but being that it is so important to deal with this part and so many traders fail for various reasons, assessing risks the right way, let's focus at least in this video, and maybe I will do one or additional two if there is going to be demand for that, assessing only the risk, okay? And we'll try to assess the risk based on percentages, not points. Of course, we're going to look at the most important stocks that delivered, meaning stocks that were up 10%, 5%, 20%, not 140% for the reasons that you will see in a minute. But I'm not going to trade, assess, and waste time on a stock that's up 1%. If the stock is up 1% all day, then why would you risk 1% to get at most 1%? So it makes no sense. So we want to go directly to the winners, check their intraday pattern, look for an entry where the risk is no more than 1%. And the beauty about this idea and this strategy is that it doesn't matter how big the position is. 1% of $1,000 is $10. 1% of $25,000 is $250. 1% of $50,000 is $500. But your decision, how big the position is yours. I mean, nobody controls that other than you. So if you feel comfortable with the loss of, let's say, $1,000, then 1% of your position can be up to $100,000. Okay, it doesn't fit all stocks, but you'll understand what I'm talking. And I don't know that many day traders are using this benchmark, $100,000 per position, but $20,000 to $30,000 seems reasonable to me. So in this example, I will use $20,000 as the entry. In terms of money, it doesn't matter how many shares. It can be 100 shares or 500 shares. Most of the US brokers don't charge commissions anyway. And it's not like those are going to be a huge factor, although they are a factor in some parts of the world. So let's dive immediately into the explanation. I will ignore at this point two stocks, one that's up 120%. You can see it here. Those two. Why is that? Because those stocks definitely don't fit the strategy. So you cannot trade a stock that's up 100 and how much was it up? 140%, and at one point 200% with 1% risk, because just look at the chart. The stock moves 10% every 5 minutes. So that's not going to fit. But let's look at the rest of the list. Okay, so let's start with Neon. Now, just a random list that was last Friday, the 13th. That's I'm doing this video on over the weekend. So Neon, volume nearly 5 million shares. A range percentage. Okay, that's a lot. 79%. That's okay. Let's check it out and discuss it in a bit. So this is the stock. Okay, now I understand. That's a SPAC. So that's a SPAC that started to move like crazy on news, and as you can see, there's immediately I can pinpoint you to a trade. This is let's call it. Hold on a second. Let me see exactly the number here. So the stop loss will be 15.75. Okay, 15.75. If I want to risk on a $16 stock, 1575, that's more than 1%, that's almost 2%. Okay, it won't fit this strategy. Keep in mind, again, the stock is up 68%. But just for the sake of argument, I'm looking at this support level, so this is where the stop loss should be, 1570. Now, can I enter just to make a point at 1570 plus 1%, which is 1585, meaning 15 cents or 16 cents? I can do, but again, it doesn't really fit this 68% change in price and the immense volatility, and not to mention the run here like crazy on the way up, which is totally unfit. So this part is totally unfit for 1% 1% risk, not reward, because we're looking way more for a reward. Okay, so let's keep this what is neonate, okay, and move to circle. The stock is up 25%. Let's see if it can fit. It's a $130 stock, so 1% is $1.30. Can we deal with this stock? Try to find an entry, a reasonable entry with a $1 with a 1% stop loss. Let's see if we can. First of all, in the morning session we have a round number 112 tested level. Okay, support is at 108, so that's $4. That's not 1%. Okay, no go. Let's see if there are any other entries with 1% risk reward. This 118. The pullback is 117. Yes, we can. Okay, so we can decide that we can enter this trade at 118. You know what? The risk reward is actually 116.50, not one. Okay, just for the sake of argument. Okay, so let me just give you the example here. It's not going to be very accurate. So I'm entering this stock at 118, and I'm buying $20,000 worth of CRCL. Guess what? It's less than 200 shares. I can do the math. It's going to be around 180 shares. So 180 shares I'm buying with a limit order exactly at 118. I can maybe buy with a market order, but I know this stock. It's very, very spready. Limit order guarantees that I'm not going to get filled above 118, and the 180 shares, it's definitely not a big quantity, and I'm going to risk, in this case, 1%, which is $1.20. And let's say this is the real stop loss, $1.20, meaning this stop loss, and I'm entering this trade, and it survives. Okay, so I'm making a point here, because in this case it's not really enough. Now, am I guaranteed to get on this $1 risk? How much does this stock move? $15? Not really. That's not 1 to 15. It's not going to happen very often. Okay, maybe it's not ever going to happen to you. Okay, but I think you catch the drift now. You see that when you're picking the right stock, okay, and this is the beauty of this strategy and the combination between great intraday movers, the market that we're trading today, and this number, which is not a random number, it's a real number. 1% risk fits, I think, all, maybe not all day traders, but those who don't like to take a lot of risk and want to work on entering trades with, with patience, with risk management. And worst case scenario, you risk 1%, not of your account, of your position on a trade. I think this is something that you need to cope with as a day trader. Okay, so 1% of your position, we decided already that your position is $20,000 and you lose 200. Assuming your account is $30,000 to $40,000 in the US, that's not a big. It's not a big deal. Now if you're trading outside of the US and your account is 10,000, okay, so you don't buy 20,000, you buy 10,000 and you risk only 100. So again, it's very scalable, okay? Especially when you're trading high volume volatile stocks. One of the reasons why those stocks are volatile is the definite increase in volume. So this is one example. Let me actually go to a way simpler example, but you know, I see that I overran the subject, and I will do another video tonight and post it, and if not, tomorrow. So let's go to this one, to this stock, Frontline, which is definitely not a $200 stock. Okay, so Frontline, why is Frontline on our watch list? Because it ended up the trading day up 7%, reasonable, delivered a huge gap up, then pulled back, and I'm looking at this entry. Why this entry? Because you can see here great clear support at the round number, and an entry can be 19.10. So a $19 stock, the risk is 10 cents. It's actually less than 10% because a 10% here is 20 cents. But let's say this is my 1%. Okay? So in this case, I'm just making a point. It's less. I'm entering at 19.10. Let me see exactly, guys. Okay, so you can see stop loss 19. I'm not making up. That's the chart. Entering 19.10. That's a 5% stop loss. But again, let's not be picky. Sometimes it will be 12%. Sometimes it will be 8%. Let's call it even at this number. So I'm buying here $20,000 worth of FRO. In this case, is worth this position is going to be $1,000, 1,000 shares, maybe more. But like I said, it doesn't matter because I'm only looking at the money. I'm buying a position worth of $20,000. I don't care how many shares are in it. Again, most of the US brokers are not going to charge me more for that. And if they do, so be it. Now again, in this case, you can see that the stock moves up 70 cents. On a risk of 5, let's call it 10. So again, 7 to 1. And I'm not saying that I'm going to sell exactly at 7 to 1. I'm just making a point that if you pursue the right stocks and insist of the very low risk entry, the worst case scenario is 1%, because it cannot be more, because that's what you decided, and the liquidity is perfect. And the best case scenario can be intraday, 5, maybe 5 to 1, maybe 15 to 1. Okay, but again, the idea here is on this subject is for the risk to be managed. Now, regarding the reward, we'll have to work on this in other videos. But here it's super important because this is where people fail. We fail as day traders across the board. But I know because I failed so many times. But failing at the risk really goes into your not only into your bottom line, it goes into your willingness to trade. I mean, what fun is it to stay 5 or 6 hours in front of the charts and lose money? So maybe you make less money than you could when you mismanage, but losing money is really the worst. It goes into your into your ability to continue trading. So again, I gave you just 2 examples here. That's going to be the end of this video. I will do tomorrow a continuation, and I will skip the introduction, get into 3 or 4 more examples, and hope that some of you will get on top of this strategy. Thanks a lot. Please like and share this video with your friends. Thank you.